Hello and welcome to the Property Trio, the podcast for the sophisticated property buyer. Today, we're diving into one of the biggest talking points in the housing market right now, and that is the expansion of the home guarantee scheme. In fact, it's been brought forward. It's in place now from the 1st of October. More home buyers can purchase with just a 5% deposit, and it's a big change already getting a lot of attention, and there are some serious ripple effects that we want to unpack. And to help us make sense of it all. Do that again, Jamie. To help us make sense of it all, I'm joined as usual by Dave and Cate. Hello.
Hello, I'm loving this one. It's an exciting episode because it's changed the landscape of a lot of markets, and it's segmented markets as well. So this will be fun.
Yeah, really topical at the moment.
Yeah, did you notice everyone was talking about it as a new scheme rather than a brought forward scheme? I think,
or an expanded scheme. We already had this scheme. It was just that it was restricted, but I won't give the game away just yet.
Okay, good idea. Let's keep our powder dry. So, Dave, I want to start with you and let's get to the basics. What has actually changed in the home guarantee scheme, and why is it such a big deal for first home buyers, and we would contend investors as well?
So as you said, from the 1st of October, the government has followed through on its election promise to expand the home guarantee scheme. It was already in place, but what they've now done is allow eligible first home buyers, every single one of them, to purchase with as little as 5% deposit, whereas there was a limited numbers available to access it previously. So that's sort of one of the big changes. So that means they can purchase with as little as that 5% deposit and not have to pay lenders mortgage insurance. And that's because the government acts as a guarantor for up to the other 15% of the property's value. So on the books for the lenders, even though someone's borrowing 95% of the value of the property, the actual lender considers it an 80% loan, and that has repercussions. And one of the key repercussions is that you don't need to pay lenders mortgage insurance. And to put a dollar value around that, if you're borrowing 95% of a $1.5 million purchase price, which is the upper end of the scheme that's available just to buyers in Sydney, that's saving you $65,800 in lenders mortgage insurance. So that's not to be sneezed at. That's a huge sum of money. But that's big. And even if you're at sort of maybe around the mid-range of 800,000, which would be achievable in many of the capital cities, that's still saving you $33,900 ballpark. And if you're down at the lower end accessing this scheme and say you're borrowing $350,000, that's still an $11,000 or $12,000 saving on lenders mortgage insurance.
As a bit of an aside, Dave, it begs the question, how do we get into this LMI business? I mean, I don't remember it being such a big sum back in the days when I was availing myself of that. We're talking big biscuits these days. Has the percentage of the purchase price increased over the years?
No, it's just purchase prices have increased, basically. So that's why the numbers seem so high. Yeah, but the system in terms of how it's charged, just the loan amounts are much bigger, so people pay more mortgage insurance.
Yeah, so we've got the government on the hook for that 15%, so there's no insurance needed when, they're making up the gap to that 20% deposit. And you said the word eligible, so there's some stuff we've got to unpack on that. And of course, the caps for different cities are different, so strap yourself in. We're going to cover all of that off as well. So in essence, it's just really designed to help people get into the market sooner. But the key here is the income caps have been removed altogether. And of course, those price caps have gone up, Dave.
Yeah, that's right. So interestingly, the changes were brought forward from January 1. And as I mentioned earlier in the year in our episode on predicting prices for this year, it effectively sent a price signal to investors, encouraged them to jump into the market ahead of the wave of first home buyers who are likely to push up prices for properties that fall within these new price limits. And I imagine the government had that in mind to some degree when they decided to pull it forward to October 1 rather than waiting until January.
Yeah. Previously, you could earn up to 125,000 as a single person or 200,000 as a couple to qualify for the scheme. So now that there's no limit on income, you can be a first home buyer on $1 million a year and still qualify. It's all about the cap of the value of the property as opposed to income caps.
How do we feel about that, just as a bit of a thought experiment, that you could potentially be in a household with $2 million of income, but the government is still helping you out with a guaranteed deposit so you can get in at 5%? I mean, typically everything's always been means tested for most things in Australia, but this one they've decided not to. I'm wondering whether that would attract, some ire from the opposition.
Look, I could put my socialist hat on or my practical hat on. The socialist hat says it's not fair. The practical hat says when someone's earning $1 million a year, they're not buying a property sub 950 to live in. That is the reality. And a question for you, Mike, how would you feel if the income cap did exist and as a single person you could qualify if you're earning up to 125 and you're earning 125 500? How would you feel?
Yeah, you'd be pretty disappointed, or at least
That's
I'd
right.
be looking for ways to get a pay reduction, which I don't often talk about. Yeah, right. Well, not just that cap in the mix as well, but there was a limit on the number of people who could access the scheme, and that's been removed as well. And I spoke about this in previous episodes because, typically it worked out to be around 40 or 50,000. So, often there was 40,000 and there was an extra amount if you were going to build a home. But let's just take 40,000 as a number. Compare that to the annual first home buyer transactions, which depending on the year obviously goes up and down, but in and around 130,000 transactions a year. So presumably there's a lot more of the market that can access this. But Dave, talk to us about those price caps.
Yeah, so look, I mean, I think we're going to see a flood of more first home buyers accessing this, as you just alluded to, Mike, and we're seeing that anecdotally in our business, which we'll come to. But then, also we've had, as you just spoke about, the income caps removed, anyone can access it, no limit on the numbers. And then also the price caps have increased, and that's been substantial in some cases. So, for instance, in Sydney, the price cap was $900,000, and now that's been bumped up to $1.5 million. So, that's a significant jump. And you can't tell me that doesn't push up Sydney prices and continue to push them higher than in other states, given their price cap is much higher.
Yeah.
I agree with you, Dave. And it is an interesting one because I've certainly in our own home state, I've seen the prices that are closer to the cap moving faster than the prices well below the cap. And it does beg to consider whether a low income earner, so for example, in Melbourne, it's 950 is our cap. A low income earner might be targeting something at the 550 or 600 limit. And I have found in the marketplace that those lower price points haven't been as under pressure as the higher ones that are closer to the cap. But it's also interesting to note that the new price caps appear to have been set just below the median value of a house in each major city. So we will talk about the flow-on effect of that.
Yeah, I mean, it's obviously clearly deliberate. The idea is to keep the scheme targeted towards your typical, in inverted commas, first home buyer stock or properties rather than pushing people into necessarily premium suburbs. It's a subtle way of controlling how much upward pressure the scheme could place on prices in the broader market. But yeah, if we look at the median values according to Cate, pretty much every single median value that is just above the new price caps. So they've basically looked at Cate's median value for houses, I should clarify as well.
Yeah.
And then basically every single city's cap, bar none, is rounded down to the nearest 50,000.
Yeah. You're absolutely right.
Interesting
I'll just quickly, or Mike, maybe if you want to just read through what those caps
happy
are
to
for
do
each capital
that.
city.
And it's good to observe the increase is not uniform across the board. For example, Melbourne's gone from 800 to 950. Perth has gone from 600 to 850. So obviously we're talking maybe the same dollar increase, but as a percentage terms, it doesn't work out like that. So it's fascinating to sort of,
It is
I guess, look
fascinating.
behind the curtain as to how they came up with it. We'll probably never know. But to
I'm
go
guessing.
through,
Well, I
sorry,
think
My
Kate.
guess. My
what we
guess
just
is that they
said.
probably, when they set the last caps, they probably did a screenshot of where the capital city median values sat at the time, and now they've done it again. Now, if I'm daring to put this forward, I think that they took the I think that they took the values from last year as opposed to this year, even though it's been rolled out this year. And the reason why I say that is I'm looking at Darwin, and that's the only one that hasn't had the cap pushed up to just under the median house value, because Darwin's had such a very busy, heady rush in recent months. But if you looked at Darwin 6 months ago, it still would have been eligible for that same 600. So it's very interesting that some of them have had real jumps. I look at Adelaide from 600 to 900, and Brisbane from 700 to a million, and Sydney from 900 to 1.5. Those markets should be getting very energised.
It's like initially whoever determined it went, okay, Sydney's the most populous city. Let's 900. What do you think, guys? Yep, that seems reasonable. Melbourne, second most. What do we reckon? 800. Yeah. Brisbane, okay, third largest population, 700. Look, the rest, Adelaide, Perth, price, 600 seems good to me. And ACT, price is 750. We'll go for that. Whereas now, you
look on the invite list for these Treasury long lunches.
I've got a lot of family members who are in the public service. Median house price for Sydney as of August 25, 1.521. Its cap's 1.5. Melbourne's was 956. Its cap's 950. Brisbane's is 1,040,000. Its cap's 1 million. Adelaide's 906. Its cap's 900. Perth 881. Its cap's now 850. Hobart's median is 724 for houses. Its cap's now 700. Darwin, as you rightly pointed out, is now 654 as of August. So rounding to the nearest 50 would be 650 cap with that recent price range. But I'd say, as you said, Kate, they looked at it a bit before August median price. So its cap is 600. ACT is 1,008,000, so its cap's 1 million. So it looks like they've almost certainly looked at the median house values of totality and rounded down to the nearest 50,000.
Because I suppose what they are concerned about, and they've obviously been questioned about it, is what pressure it's going to put on prices. And we'll talk about that in terms of their modelling in a moment. But I want to go to you, Kate. We had the REBA president observe that below the Brisbane cap of 1 million, she saw within a month a $50,000 increase in prices in that sort of bracket. What are you seeing on the ground, and are people really taking advantage of this?
Yeah, they are. I saw prices really jetting along in this category of houses, not units. Units have been impacted, but houses have gone through the roof. And Melbourne's really had the trifecta, because we've traditionally, or over the last few years, we've had good first home buyer participation for whatever reason. I think the first home buyers have gained a little bit of confidence because investors have been out of the market. Also, we've had a lot of investors selling off, so investor-led sales. But the trifecta that's hit us is also investor confidence from interstate. So all of a sudden we've had a wave of investors, and they all want houses. And we've also had this scheme kick into gear. And even before it started, when the announcement came in that the date would be brought forward to the 1st of October, that we had a mad flurry of people wanting to beat the first home buyer deluge. So we have seen prices move, and dare I say it, in some of the markets that are offering established houses near, good amenity, rail, schools, etc., in that sub 950 mark, certainly in the 750 to 850 range. I've seen values move almost 100,000 in some markets, and I can list them. Certainly, Sunshine West and surrounds. Werribee's gone gangbusters. We've seen a lot going on in Sunbury. We've got St Albans. That's the western side of town. Frankston North, I think, topped the pops, and that was a key area that's been impacted by all of this. And of course, Laylaw and Thomastown, which I've chatted about before. This time last year, I could purchase in Laylaw for sub 750 and get a 3-bedroom house on a 600 square metre block, and now you need at least 820.
Whoa, that's a big jump.
It is.
And look, we've seen this and we've talked about it happening before, haven't we, with other schemes? And when they come in, it immediately pushes up prices and carries them up to the limit that the government sets, as it has in this case. And so, it's just history repeating itself, as so often happens with these types of schemes. I mean, on the ground, in terms of in our business, talking to our strategic mortgage brokers, we've got a much higher percentage of first home buyer pre-approvals. So that's definitely bumped up. We've seen much more inquiry from first home buyers. So, and looking at the numbers at the moment, we've probably got 60 to 70% of our pre-approvals are with first home buyers, and only 30 to 40% with investors and the upgraders. And that's probably generally flipped or the other way around, or closer to 50-50. So, yeah, we've certainly seen a big bump in first home buyers in our business.
Well, let's zero in on some of the minutiae and exactly how the scheme works, Cate, because there's a lot of detail in there. In terms of eligibility, what do we need to know?
Well, to qualify, you need to be an Australian citizen or a permanent resident. You've got to be 18 or over, and either a first home buyer or someone who hasn't owned a property in the past 10 years. I must say I like that change, because it was pretty unforgiving around ownership previously. It is strictly for owner-occupiers, so you can't use it to buy an investment property. The home that you buy must be one that you intend to live in, and that could be an existing property, a townhouse, apartment, house and land package, off the plan unit, or even vacant land with a separate build contract.
Yeah, there's actually a common misconception also, because there has historically been this with other first homeowner grants, that you can move out after a year and turn it into an investment. But that's not, they've made sort of some stricter policy around this particular scheme. So that's not how this one works, which our listeners should note. So if you stop living in the property, your loan can actually be reassessed, and you might end up needing to pay mortgage insurance or other costs. So it's a really important distinction. And that would mean, your loan is no longer covered by the scheme, while your LVR is still above 80% potentially if you haven't paid it down or the property value hasn't increased. And then you would need to then pay lender's mortgage insurance in line with your lender's policies and loan conditions. So it's just it's spelled out in the online eligibility for the Australian Government Info Guide, and it's not necessarily black and white how this would be approached, but it does say, if you rent out the property, turn it into an investment, then you potentially would be in this position. There are some other points that it includes as well where you might be in this position, so it's something to keep an eye on for anyone entering the scheme.
There would have to be a statute of limitations to that, I imagine, because at some stage, if someone is either making the decision to upgrade and either treat it as a stepping stone and they sell it, or retain it because they've now got the means to do so and convert it to an investment property, at what stage do you think the government would not hold firm to that decision?
Given they don't seem to give a specific time frame, I think they basically will keep that up their sleeve until you're able to achieve an 80% loan to value ratio on your own.
Yeah.
Yeah, so typically it would be at least 6 or 12 months that you need to occupy the property as part of the first home buyer grant. I've even seen people try and get a little bit creative with that and be fined for not occupying, and that's pretty easy to tell when you look at postal records and driver's licenses and utilities usage, because some people were just sitting them vacant and then renting them out. But I guess like once you pass that, let's say it's 12 months, it's not really up to the government anymore. It's really up to the bank, right? So if you can revalue at 80%, you're off to the races. If you can't, then the bank might be going, okay, well, we're going to have a chat about this.
Yeah, I think so.
Yeah, exactly.
And just on top of that, there are a few requirements in terms of the lenders as well. So the loan must be with one of 33 participating lenders over no more than 30 years, and it has to be principal and interest. So interest-only repayments are only allowed in some cases. Typically, one of those cases, or perhaps the majority of the cases, will be when you're building a home. And during the build, you generally pay interest only on the funds as they're drawn down. And that, of course, helps with the cash flow with something that isn't available to produce income, or let's just say minimize your rental requirements to pay because you can move into your home. Once the construction is complete and the loan is fully drawn down, it obviously will revert to principal and interest payments. So it's a practical setup that recognizes how the stage funding works in the construction sense. So it's good that they've thought about that.
Yeah, and it's also worth noting that you're expected to use most of your available cash for the deposit. So this is a pretty interesting point as well that's quite unique to this scheme. So if you have 20% or more saved after covering other property purchase costs, e.g. stamp duty, legal fees, then your home loan won't be eligible for the scheme.
It's interesting, that one, isn't it, Cate? Because we've got like no cap on your income, but there is sort of like a cap on your savings. You know, like if you've been a very, very diligent saver, then it can almost count against you.
Yeah, well, they do actually say on their information sheet, you must use as much of your savings as possible for the deposit based on your participating lender's policies and your financial circumstances. And I've got clients at the moment who are eligible for this, and they had a dilemma when they'd accumulated more savings throughout our search. And, you know, as crazy as it sounds, they were talking about maybe having a holiday because they really do need to take advantage of this.
That's silly, isn't it? Like, I mean, there's always these unintended consequences when we put policy things out there. And just imagine like a diligent saver is like, oh gosh, I've got to change my very, very healthy and wonderful saving habits because it's going to trigger something that means I'm going to be worse off. So I've got to blow the cash somehow.
Well, I've got an issue with it. For that reason, but you know, these particular clients that I'm working with aren't looking for something that is a renovator. But I've worked with clients that are looking at properties that are pretty scruffy, that will need maybe a kitchen upgrade or new carpets or whatever, and they're wanting to have buffer funds that they can spend on getting this property to, you know, a more livable condition. And the clients that were contemplating a holiday are looking at apartments that have higher outgoings. And we've talked all through that. They understand how I feel about high OCs, but you want a provision for all of those things, particularly the unforeseen ones like special levies. So I don't like the disincentive there for accumulating some savings, because I think that's a key to successful buying for a first home buyer.
Well,
you talk 100% a lot about
100%.
Cash buffers, right? Because
exactly.
And then this, in a way, it's kind of like taking that away from you. It's like, we want you to have a mortgage, but we don't want you to have any cash in case something goes wrong.
Exactly. And that's what happens when you have a vague policy. There's a vacuum of, how do we approach this when the definition is you must use as much of your savings as possible? So what does that mean? It's different to every individual. So, you know, what we're finding is, as usual, different lenders have different rules because there's a policy vacuum. So then they have to make up the rules themselves. So then, you know, depending on which lender you go to, the rules are very different. So, for instance, you know, we had a client who was going to have about $15,000 left over in savings, but the bank said, no, that's too much. So they had to reduce their loan by $5,000. This, arbitrarily, and contribute more of their own cash, leaving just $10,000 in the account post settlement. So that was with Unibank, just a name and shame. And unfortunately, because some other policy quirks for the borrowers, that Unibank was the only lender that were able to take these borrowers on. Now, in contrast, another client was going with a different lender. This was Westpac, and they had more than $20,000 left over, and the lender Westpac was fine with that. So then you've got actually, which is at least setting a policy that's clear. You've got the NAB who stipulate, well, the maximum you can have is $30,000. You can't have any more than that. CBA have set a policy. Maximum you can have is some randomly $23,000. So, while there are 33 participating lenders, the best move is to get advice from a strategic mortgage broker like ours, ideally, who knows how each lender applies the rules, because it makes all the difference to your approval and how much cash you're allowed to keep as a buffer and your risk management strategy post the purchase.
A lot of nuances in there, especially if you're wanting to reno. You need to keep cash in the bank to pay for those improvements, and everyone should have a safety buffer. I mean, presumably these are people, even with this 5% deposit, are going into mortgages that are going to sting. It's going to be painful, right? Like they might be sort of, having a tough time, and then we've got this inability to have a cash buffer just to cover the fact that they might lose their job and have to go somewhere else, or someone could get sick, or the hot water system breaks. I don't like it that much.
Yeah.
No, look, I think what they should do is it should be a percentage of the loan amount, and the government should stipulate this, and then it's uniform, and then it's proportionate to how much you've borrowed. Because, they're saying, you borrow 95% of 1.5 million, and your buffer's only allowed to be 23,000 with CBA, you're at much greater risk because your repayments are much higher. The costs on upkeep on that home's much higher. So you're actually putting your clients into more risk. Whereas if it was, say, 5% of the loan amount, well, if you're borrowing 1 million, you can have a buffer of 50. If you're borrowing 500,000, you can have a buffer of 25,000. Yeah. That would be a much more logical way to approach it.
Yeah, and as Cate said before, like the special levies for apartment complexes can come at inopportune times, and I've seen many of them, 10, 20, True. 50, even $100,000 plus. That would be absolutely gutting. Anyway, let's move on.
Just set a percentage. It's so simple.
Yeah,
set a percentage.
Just
of the loan amount.
Consult with some qualified professionals before you launch a policy. That would have been a game changer, just to talk to, 2 or 3, a panel of good mortgage brokerage firms would have given them some insight that would have been very valuable.
Well, for a long lunch with the Australian Labor Party or whoever it is, I mean, we'll give them some advice. So I'll just throw that out there. Let's talk numbers. What kind of difference are we talking about between a 5% deposit and then having to save for what the media likes to call a standard 20% deposit, or at least a deposit that doesn't attract LMI?
Yeah, well, let's use $800,000 as an example. That's a nice round figure for a property. Traditionally, you'd need to save $160,000 for a 20% deposit to not have to pay lender's mortgage insurance. Now, I'm not talking about stamp duty here, by the way. That's another expense. Under this scheme, though, with your deposit, you'd only need to save $40,000. That's a huge barrier removed right there. Plus, you don't have to pay LMI, which could otherwise cost around $32,000 on that particular purchase. So, for example, if you borrowed 95% of an $800,000 principal place of residence, you'd have a $760,000 loan plus this LMI bill. So that's money straight back into your pocket, plus, and very importantly, $32,000 less than you had to save, so it does enable you to buy sooner.
Yeah, and it's a really good point, Cate. And it's important to remember that there are a number of other grants and concessions on the state level that can also be used in conjunction with this, we're literally throwing money at first home buyers around the country. So, for first home owners grants for buying or building a new home, depending on the state, they can range from another $10,000 to $30,000 that they have given to them by the state. There are also a number of stamp duty waivers and concessions for first home buyers. Typically, there will be a price cap for these, like there is for this scheme, where eligibility for the first stamp duty waiver gets cut off. So, for example, in Victoria, the cap is $600,000. If you purchase a new home at this price point, you could obtain a $10,000 first homeowners grant in Victoria. You could get full stamp duty waiver of $31,000 and not pay lender's mortgage insurance, which would be around $25,000. So someone purchasing for $600,000 in Victoria would effectively be receiving or saving up to around $66,000 in today's day and age.
Yeah, that's pretty meaningful. I wonder why the stamp duty thing didn't sort of come in and make this a double whammy, but I guess that's a states thing, and they're so addicted to that revenue that there would probably be major debates. But one thing that is interesting to me, Dave, is that even though the deposit is smaller, the rates on the loans aren't necessarily higher. And typically you would say that this is a higher risk loan, so you're going to have to pay a premium on the interest. But with the government in the mix, it doesn't happen that way, does it?
Yeah, that's right. So it's another benefit to the first home buyers getting into this scheme on top of those just mentioned. So as you said, normally with a 95% loan, you're being charged a higher interest rate to offset that risk. But under this scheme, because the government is the one, not the lender, guaranteeing the other 15%, the lenders have decided to treat the borrowers as if they're borrowing an 80% loan to value ratio, and therefore they're accessing the lower interest rates of an 80% loan. And what we're also, no surprises, we're seeing heating up is fierce competition among lenders in this space as well, because they know there's so many buyers, about to come on. And, we're seeing it at the coalface in our office with a lot of pre-approvals for first home buyers. So, yeah, there's really competitive offers from all the lenders looking for a slice of this first home buyer market. And look, I know when I completed my first purchase in my mid-20s, I borrowed 95% and paid mortgage insurance and didn't have any other assistance other than this. I did access a $7,000 first homeowner grant. So, there's some pretty good opportunities for first home buyers out there today. I think you borrowed 95 and paid LMI too, didn't you, Cate?
No, I saved 20%.
Oh, you saved the full 20.
Oh,
Good.
Yeah.
What a show off. Took a longer.
Yeah, and we didn't have grants. It did take me longer, but I was at university, so I was working at the Coles Deli and getting really good money because I was doing night duties, but it was casual work, and I just had a really good array of hours all the time. But I needed to qualify for the loan with consistent income, so I managed to save quite a bit.
I don't know why Mike.
I don't know why we should be surprised that Cate saves 25%, Dave a little bit more renegade at 95%, and me, I think 102% loan with Rams in the heyday of lending.
That's right. Yeah.
Just before the GFC.
You just had to demonstrate that you could save. You had to show genuine savings, but it didn't have to be much.
Yep.
I love
I
that.
showed that I could save in the lead up to the weekend where I blew it all, and I had a pulse, and they're like, "We have got the product for you."
And then the GFC hit.
Yeah, that's right. 2008 game changed.
Yeah.
I wanted to chat about that question that you asked, Dave, Mike, because you were basically inferring that for a higher LVR, technically, the loan amount should be higher because of the risk that it represents. And clearly, I'd like to think that there's been some research done around first home buyer risk, and I certainly know anecdotally, when you see defaults, it's typically not first home buyers. And the other thing about first home buyers, aside from having a bit of a safety net with parents or an ability to get friends to come in and, rent a room or pay them cash or whatever we want to call it, cut down on their expenses because they don't all have, kids at private schools and that kind of thing. There's also, we can accept the fact that for a lot of first home buyers, their income trajectory is looking good. So
Yes, 100%.
clearly there's a reason
much
why.
more likely for their income to increase over the years, which is why it makes sense for first home buyers to take a bit more risk.
Yep.
That's right. And the government is supporting it. They're guaranteeing it. So clearly we wouldn't be putting this olive branch out and having all of these guarantees in place if we had people defaulting on their loans in number.
Yep. If we look at, say, mortgage defaults, I think in the March 2025 quarter, they rose to 1.36%. I've done some modelling on this business that you didn't even know before today we were going to start, Dave. If you're talking about, let's say, a $950 purchase and you're paying, somebody's threw out $32,000 worth of LMI. That's probably not technically correct, but it'll do. That means that if we're having defaults on 1% of loans, then we can sort of times that 32,000 by 99, because 99 out of 100 loans don't have a problem. That's worth 3.168 million. And if there's a default and the bank's on the hook for, let's say 950, that's a 3.3 times multiple that
Return.
they are making. Yeah.
Yeah.
Hell of a business.
Yeah. Well, I
Where
think
do
a
I
lot
start?
of the insurance companies who do LMI weren't too happy with the government taking a lot of their business
bet.
away either. So that
Yeah.
there was certainly commentary around that from some of the insurance companies. Yeah.
Absolutely, because that would be the most dominant cohort, because by the time you're upgrading, you've probably got enough equity.
Absolutely.
Put your hand up if you are genuinely concerned about the plight of insurance companies in Australia.
To be honest, I am. Not
I
mortgage
want
insurers, but across
all
the
businesses
board,
to do well.
we need our insurers. If they all go belly up, or some do, our insurance premiums will rise, and we've got a hell of an insurance issue staring us, in the face at the moment, in particular to home insurance.
Yeah, look, I completely agree. We want them to be solvent, but I'm pretty sure that they've passed
Just
on
not too.
lots of increases to cover their risk. I don't think we need to worry about them from a humanitarian perspective. I don't think the CEOs are, eating 2-minute noodles at the moment. So without even watching on YouTube, you can probably assume that not that many hands went up, and Cate's went up in a sensible way. And we're used to her being the sensible voice of reason. But Cate, it's not all roses with this scheme. We talked about the stamp duty. What other costs should people be aware of?
Well, that really is the other cost, and it's a significant one. Even with the scheme, you're still on the hook for stamps. And in Sydney, for instance, the stamp duty exemption only applies to homes up to 800,000. So if you're buying at the 1.5 million cap, you're looking at more than 60 grand in stamp duty alone on top of your 5% deposit. So it's nothing to sneeze at. If you purchase for 801,000, then you'll pay $197.06 in stamp duty. And you've got some numbers here for me, Dave. 1.1 would equate to 43,912, and 1.5, over 60,000. So this will keep a lot of first home buyers trying to purchase under that $800,000 level if they're conscious of the need to save for stamp duty. But for many, it won't be an option if they're wanting something a bit bigger or in a certain location. We all know what the Sydney market's like. You need to be prepared to spend, sign a contract that starts with a 1.
Yeah, and look, in Victoria, it's even a bit more complex. So the full exemption cuts out at 600,000, and then there's only a partial reduction up to 750, so you could jump from like zero at 600,000. So it's not quite as well scaled as the one in Sydney. So up at 750,000 purchase price, you're paying a $40,000 stamp duty. So even though you're paying an extra $150,000 only on the price point, you've gone from zero stamp duty to $40,000. So that, it's a pretty big incentive to stay close to that 600,000 mark in Victoria. At $850,000, the stamp duty becomes $46,000. and at Melbourne's cap of 950,000, you'd pay $52,000 in stamp duty, which is actually more than the 5% deposit of 47,500, because Victorians pay more stamp duty than any other state relative to the price point. So you can see all these distortions that it creates in the marketplace. So the 5% story isn't the whole picture. You still need to factor in where stamp duty kicks in, how much is it going to cost you, where are you going to pitch your price point relative to where you want to live, but also how is that going to impact your cost of stamp duty. And look, for most of the first home buyers, depending on, well, if you're paying a reasonable level of stamp duty, you probably actually need to be saving 10% to 15% of the purchase price, because you'll need to cover all your costs, but also leave yourself with a buffer. And that's where the strategy matters. You know, you don't want to, we've touched on this, you don't want to empty your savings out entirely just to purchase your first home. So, yeah, you could actually make a case that, as we've touched on, that the banks are leaving the borrowers and the government at risk by forcing people's buffers to be so low after they settle on the property.
That is definitely a concern. All right, let's get to brass tacks, the $1 million question, and I want to hear from both of you. What's this going to do to property prices? Maybe starting with you, Dave.
Well, Treasury has estimated, they're obviously singing off the song sheet that the government wanted to receive, that the scheme would only lift prices nationally by 0.5% over 6 years.
I'll go down for that.
That seems pretty ridiculous. I don't know how they came up with those numbers, but the acronym BS comes to mind. But some independent analysis suggests, without surprise, that it could be higher, potentially 3.5 to 6.5% in 2026 alone. So in simple terms, more people being able to buy with smaller deposits means more demand. So whether first-time buyers on the scheme, upgraders competing within that price bracket, and investors competing, they'll all want to get in before the rush. So guess what? That's going to create a stampede. And, that puts upward pressure on prices, especially within the popular brackets like 1 to 1.5 million in Sydney, which is already really competitive. So, I certainly think that 3.5 to 6.5% uplift in each of the cities and regions price brackets is much more likely. And keep in mind, this is on top of the price growth that's already occurring in every capital city.
Exactly. Yeah, we're seeing that segment really heat up. And once buyers know they can borrow more under the scheme, they do tend to push their limits, and that can feed price growth. But the Reserve Bank has suggested that supply increases could help offset that over time. And as demand rises, developers might start bringing in more properties and projects, which could help balance things out in the medium term. And that can be true of vendors as well when they see a market that's showing healthier signs, and particularly when it switches from buyer's market to seller's market, that can really initiate some vendors to make decisions to sell and to upgrade or downsize. But you constantly have that chicken and egg issue when a market is performing across all segments. And the chicken and egg issue is that vendors don't want to sell until they know what they can buy.
Yeah, for me, it's too big of an if. Like, the RBA would love to consider that there's a short-term bump that evens out once stock enters the market, but we can see with the National Housing Accord's target of the 1.2 million homes over 5 years, we're into our second year now. We're about 30% behind, so I think that's very wishful thinking, but the government is trying to get a balance to help first home buyers, which is of course important and admirable to a nation of property devotees, but not wanting to set a fire under it, especially with housing being a big chunk of the CPI basket, Dave.
Yeah, look, it really is a delicate balance, isn't it? One of the takeaways is that it's a great opportunity. Absolutely, potentially the best opportunity ever for first home buyers. But look, it's definitely going to push prices up further for everyone. I think if you're an investor, it's probably a good idea to get in sooner rather than later, because this is definitely going to flow through 2026 for as long as this scheme runs for. So, there isn't a magic bullet for affordability for first home buyers. What happens to the first home buyers who come in after this scheme ends, or will the government never take this scheme away now that it is in place?
Yeah, you'd be leaning towards that, I think. But anyway, that's the news on the ground for the 5% deposit scheme. That was today's episode of the Property Trio. We hope that it shed some light on how it works. And as you can understand, there are quite a few nuances, and even more important, how it's going to actually shape the market and what it means for both first home buyers, lenders, and the broader economy. But now it's time to go to our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
It's about the policy, actually. This is, if I got a seat at the table and had a chance to chat to policymakers, I do like the scheme. What I don't like are the caps, because caps can segment markets. And I just wonder, if it was an open-ended scheme and it didn't have price caps, first home buyers will self-select. You'll get very, very few that are happy to spend, $2 million in Sydney, and then they have stamp duty to contend with, which I think is also another natural break. I think if they had left it uncapped, we wouldn't be having this issue that we are in the marketplace now with segmentation, because everyone knows what the magic number is. And you've got investors that are pushing against it as well, and it's creating a lot of pressure up to a certain limit. So that would have been my suggestion for the policymakers, not to have the caps.
Oh, look, if we're talking on that topic, I would say that, I think they could have spent more time on the scheme to make it more appropriately targeted. Now, how that looks, you need to dedicate hours into thinking about that. But we know the people who find it hardest are singles who don't have any assistance from parents, and who are on low to medium incomes. They're basically, because I'm going to do an article and an episode soon on why it's no harder to get into the property market as a first home buyer today than it was 50 years ago. Just the challenges are different. But if you boil it down to three segments that are the hardest, who it is the hardest for today is singles, low to medium income earners, and no assistance from parents. So, creating some policy around that, I think, would be a much better approach and probably save, half as much taxpayers' money as we're probably spending on this.
Yeah, I like that suggestion, Dave. And as an extension to this offering, single parents are eligible for a 2% deposit, eligible single parents. And I think we could incorporate a nicer offering for singles. I think that would be a nicer way to do it.
Yes. Yeah, I think there's quite a few things that we could have played with around the margins, and probably would have solved if we were invited to that ALP long lunch. So just leaving that out there again. That's been
just give us a week and pay for our time for one full week, and we'll come with a great policy.
Just one boozy Friday, we could knock it over, I reckon.
No.
So.
Might get a bit left of centre as we have a few more drinks. But,
I do have a few extra policies I wanted to bring, but I'll make sure not to share that with you guys ahead of time. Anyway, that was the new, or let's say the brought forward and extended home buyer scheme for first home buyers. Thank you, Dave and Cate, and we'll see you guys next week.
Yeah, thanks, Dave, and your team. That was a really good ep to